Hi, good afternoon. Welcome to yet another online session on financial management. But if you are joining for the first time over the last couple of weeks, we did an introduction. And last week we did an introduction to equity. So this is just a continuation from where we left. Any questions from the last couple of weeks? By the way, I can take a couple of quick questions if you all have any. All right. No questions. Okay. I have good news and bad news. Which one do you want first? Good one. Well, good news first. Okay. You might have an extra class, and the bad news is next week you don't have a live session. And so no classes next week. We will meet in 2 weeks, right? Which means, well, next week is not Boxing Day, but it's the 27th. Yeah, 27th. No classes on the 27th. We'll meet on the 3rd of January, 2021, right? So we'll meet in the new year. No classes next week. Now we are moving into the new year, and it's very important that you all plan out next year. Okay. Now, number one in the things you need to do during next year, 2021, is to complete your banking exams, right? So you have to make sure that you complete, unless the unforeseen happens. Now, for you all to complete, there should have been an exam. If there is no exam, you can't complete, right? So let's hope this year, this year there weren't any exams, but 2021, let's hope there will be an exam, one way or the other, right? Things are beyond anyone's control. So this year, just it was not possible at all to have an exam. So let's hope it doesn't happen in 2021, and we will have enough space to have at least a couple of exams and maybe hopefully some time to cover lost ground. Now, it's very important that you have a to-do list or a New Year resolution for 2021, right? And number one in your list has to be completion of banking exams, right? Don't postpone anything. If you're taking banking exams, make sure you complete it sometime during 2021. The sooner you do it, the better, right? Hopefully the first half of 2021, if you can complete banking, that will be ideal. Worst case, sometime during 2021, right? Don't extend it beyond that. As I said, perhaps during our when we first met, banking is something that you're going to, is the easiest exam you're ever going to do in your life after grade 5 scholarship, right? No further easy exams. So don't become a fixed asset to the institute. Just make sure you complete your exams and get your qualification in order, right? Things are getting more and more competitive. Now, 2020 was washed out completely due to COVID. So everyone is waiting and gearing up to upskill themselves, to learn something new and to add to their qualifications and experience and all that. So it's always advisable that you complete your exams also on time. Just give me a second, 1 minute. right? Now, it's very important that you don't postpone anything right now. For example, if you were gearing up during 2019 for the 2020 exams, right? And if you had a chance of completing early part of 2019, you didn't want to, for some reason you postponed things and you wanted to complete during 2020, look what has happened. There has been no exams and automatically things have got dragged on to 2021. Right, so 1 year delay, but have you completed in 2019 in the nick of time? By now you would have been relaxing, laughing, maybe adding to your qualifications. You'd have been doing something more challenging, even more challenging, right? So don't ever waste time. Make sure that you complete your exams on time. In life, usually first time is the easiest time, right? In most things in life. So same goes for banking exams. Try and complete it the first time. And when you're doing your exams, take all subjects together. Take the challenge and finish it off. Right? Okay. So having said that, let's move on. So I hope that is clear. I hope all of you will complete your exams this year. You have already lost 1 year, which means you need to catch up on time on the other side. Right? The best way to do it is to do all subjects in one go and finish it off. It's not all that difficult, right? It's look at it this way. It's worst case 6 months of a little bit of hard work, not a lot of hard work. So some of these things are already familiar. You need to just firm up on what is new to you. So a little bit of hard work is there. And 6 months, only 6 months, right? Whether you put your effort to one subject or 7 subjects, it's still the same effort. You have to put almost the same effort. So finish it off. Get exams off your head. Right. So any questions on that? Okay. Well, in that case, we can move on. Type of funds, right? Okay. Now, let's assume that each and every one of you are busy professionals, right? Maybe all of you are doctors, perhaps a set of lawyers, engineers, maybe pilots, and you have substantial amounts of money where you need to, and you, for one thing, you may not have the knowledge to invest it somewhere, or you may not have the time, right? Always tied up in the operating theater, or you're flying all over the world. These days, of course, no flying, so you have plenty of time. But under normal circumstances, you may not have time. You may not have the knowledge also, right? You might be an expert physician, but zero knowledge in investing. Now, if that is the case, one thing you can do is you can keep your money for someone else to manage. Now, someone else meaning someone reliable, someone with a proven track record, and someone who will not play you out, right? So reputation matters when it comes to parting with your money and trusting someone else with your money. Right, so the class of assets that we are going to discuss today will give an idea of some of these kind of assets, investment opportunities. Right? Now, you may have heard of investment assets called mutual funds or unit trust, in fact. In Sri Lanka, it's called unit trust. Right? You may have heard of unit trusts. Have you all heard of unit trusts? No one has heard of unit trust? Well, all of you are busy bankers, so I suppose no one has real time to evaluate investment options, isn't it? So no one has heard of unit trusts. But there are actually about 15-20 unit trusts in the country. And you can go and invest in these unit trusts. Right? I'm not going to give examples, but unit trust prices are published on a daily basis in newspapers. So you can just go through newspapers, right? Go through the financial sections, and on the last page, usually, you get the unit trust prices. Yeah. All right. Now, mutual funds are also similar to unit trusts. Very similar. The operation is almost identical to unit trusts. Right. So, by the way, over the last couple of weeks, we saw some of the rating agencies downgrading Sri Lanka from investment grade to non-investment grade. Yeah. So what is investment grade? What do you mean by investment grade? What is investment grade? It is a credit rating, yeah. What else can you say about investment grades? Well, there are two types of grades. One is investment grade, other one is non-investment grade. Yes. Investment grade and non-investment grade. Right, so investment grade is the highest possible investment grade is what? What is the highest possible investment grade? Very good. Triple A is the highest possible investment grade. Then you get double A plus, double A minus, A plus, A minus, triple B plus, triple B, and triple B minus. Right. These are all investment grade. Anything above triple B minus, right? Triple B minus and above are investment grade. The lowest possible investment grade is lowest possible investment grade. The lowest possible investment grade I have already written on the board is triple B minus, right? So lowest possible investment grade triple B minus. And what is the highest possible non-investment grade, which is also called junk? What is the highest possible non-investment grade? No, before triple C you have double B plus, then you have double B minus, B plus, B minus. Triple C plus, triple C minus. So likewise, it goes further down. Further down. Now Sri Lanka is here. We are at triple C. So we are 1, 2, 3, 4, 5, 6, 7, 8, about 9 notches below investment grade, which means we are perceived to be carrying a little bit of high credit risk, right? And our target should be to climb up this ladder and hopefully get to an investment grade, which will reduce the perceived risk of Sri Lanka in the view of foreign investors. Right. Okay, now why I touched base on this is credit ratings is something that mutual funds, in other words, unit trust in Sri Lanka, will look at. When they make the investments, one of the things they will look at is whether the instrument is investment grade or non-investment grade. Okay. So it depends on the type of fund you are investing in. A mutual fund is a trust that pools the savings of a number of investors who share a common financial goal. So let's say all of you are investors. You share a common financial goal. So if I may write down some of the financial goals. Financial goals. What could be your financial goals? If you all are investors, what do you think could be your financial goals? Sorry, Prasan has asked a question. We were in B minus. Yes, we were B minus and we were downgraded to triple C. Yeah, your goals could be high returns. High returns, right? Which means the in excess of the 1-year treasury bill rate, right? Which is currently 5%. 5%. So your goal is to do better than the 1-year treasury bill rate, because without taking a lot of risk, you can buy a 1-year treasury bill and get 5%. Now your goal might be to get something on top of that to earn a higher return. Good. What else? Excellent. Lower risk. You might want lower risk. Now, for example, let's say you want to invest your money in a small finance company, right? So if you have, let's assume you have 100 million bucks to invest. Now, if you put all of your money in this finance company and nowhere else, your fate is in the hands of that small finance company, which is maybe probably making losses right now, huge NPLs and all. So you're taking huge risk, right? And you're putting all of your money in that one finance company, which is giving a good return but a high risk. So what you can do is you can put your money in a unit trust. Now this unit trust will collect all the money and maybe invest. This unit trust, in fact, may have, let's say, 100 investors, like 100 investors, each of them investing 100 million rupees. Now, what they will do is they will take the money and they might still invest 100 million bucks in that unit trust. But if that in the finance company, now if the finance company defaults, what will happen is the loss, the 100 million which is lost, will be distributed amongst all the unit holders. Right? So each person's loss will then drop to 1 million rupees. Right? So 1 million, the unit trust will invest 100 million total. It has 100 investors, each investing 100 million rupees. So that loss of 100 million bucks, which was invested in the finance company, will be distributed amongst all investors in the proportion that they invested. Right? So instead of losing 100 million, you will end up losing only 1 million. So you have pooled risk, which is less risky. Overall, your risk is less, and you have reduced your risk. Good. So you will have return goals as well as risk-related goals. Yeah. Right. So let's assume that all of you are the investors, right? Let's say you all are busy professionals and I am the fund manager. I manage a mutual fund. Professional fund managers then invest these funds in a way that helps investors achieve their goal. Right. So fund managers will invest this money. Then invest these funds in a way that helps investors achieve their goals. Now, these are the goals, right? So all of you so each of you will be giving me a certain amount of money, which I will pool and in turn I will put it in various investments, right? Various investments depending on the mandate. So this can be treasury bills, debentures, FDs, or equity. In various instruments, I will be investing. Right. Now, when I make these investments, I will be looking at your financial goals. Right. I can't totally forget your goals. I need to look at your goals and then make my investments. It doesn't go the other way around, right? I can't make my investments and then look at the goals. I have to first look at the goals, and based on the goals, I will decide on where to invest. Right? So I will look at your return expectations as well as your risk tolerance levels and then make these investments. A mutual fund is managed by a management company or an asset management company. You take all the unit trusts in the country, each of the unit trusts in the country, you will see that these unit trusts are managed by a certain particular company. Very rarely you get individuals managing a unit trust. The portfolio of mutual fund is managed by a portfolio manager. Right? So this mutual fund is managed by a portfolio manager whose responsibility is to be invested in and satisfy the desire of investors. Right? So the fund manager has to satisfy the desires of the investor. Not his own desires, but the investor's desires need to be satisfied. Every day, the fund manager, the portfolio manager, counts up the value of all the fund's holdings, figures out how many shares have been purchased by shareholders, and then calculates the net asset value of the mutual fund and the price of a single share of the fund on that particular day. Right? So I will look at all of my assets, everything that I have invested in, right? All these assets that I have invested in, and I will get total, right, the total net asset value of the fund or the asset under management. In other words, what is called AUM, and divide by what we call number of units, right, or the number of shares. Now, when each of you invests money, you will be investing in what is called a unit of the company. Right? The unit consists of the total of these investments. I'll be selling units to you, and you will be purchasing units from me, the fund manager. Now, a unit is valued based on the net asset value of the fund. So this is how it goes. Investors will pool their money with the fund manager, and the fund manager will invest in various types of assets or securities, and the securities will generate a return which will be passed on to investors. Right? So this is like a cycle. Investors will give or pool their money with the fund manager. The fund manager in turn invests in securities and generates a return for the investors. Right? Now, what happens is, in between, the fund manager will charge fees. Right? Maybe perhaps there might be a front-end fee. Right? On if a particular investor invests $50 million, he might charge upfront a certain amount of fee. right? The fee of entering the fund. Then there might be an annual management fee, which is based on the net asset value of the fund, right? The investment amount on a particular day, management fees. Okay, so that's how the fund manager earns his fees. Then there might be a fee which compensates the fund manager for overperformance, right? For example, if you were looking, your objective was to earn at least 10% return, at least a 10% return, and the fund manager ends up giving you a 30% return, he has made 30% on top of your expectation, 20% on top of your expectation. Right now, that overperformance sometimes gets rewarded. Right, there might be a watermark above that. Whatever the performance may get rewarded. So this is also a way in which fund managers earn their fees. Net asset value, the fund's net asset value fluctuates along with the value of its underlying investments. The formula for net asset value, right? It's the market value of all securities. Remember, it's the market value of all securities, right? It's a market value, very important concept. It is not the book value, but the market value of all securities held by the fund plus cash and equivalent holdings minus liabilities. In other words, it's the net asset value of the fund divided by total fund total fund shares outstanding. Right, so it's all the assets minus the liabilities divided by the number of shares. Right, so let's try this example, simple one. Right, so what's the answer you get? $12. Okay. Let's see. Did all of you get 12? Right. let's assume at the close of trading yesterday that a particular mutual fund held 10.5 million worth of securities, $2 million of cash, and 500,000 of liabilities. If the fund had 1 million shares outstanding, then yesterday's net asset value would be right? 10.5 million worth of securities, 2 million cash, 500,000 liabilities, 1 million shares. And so the net asset value would be total assets, right? So you have 10.5 million shares, 2 million cash, 500,000 liabilities, divided by 1 million shares outstanding, right? So you get 12 divided by 1, which is the value of $12 per share. So the net assets, the amount of net assets is 10.5 plus 2 minus 0.5 per share is $12 per share. Now, a small thing, right? The same thing you could have done by 10,500,000 minus plus 2 million minus 500,000 divided by 1 million. So it's 12.5, 12 million divided by 1 million. So you get the same answer. But what about the amount of time that it takes? The exam time is a crucial element. You're fighting against time, right? So try to be a little efficient in writing. You don't have to write all of these. Huh? Don't waste time writing zeros and all that. It doesn't have value. Just use shortcuts. Do it like this. Try and save time wherever possible. Try and shave off unwanted, non-value adding things, right? Because this writing it this way will save you a few important seconds. Now that's those seconds you might be able to deploy it elsewhere in a more productive way. Right? So use shortcuts as the example. Short meaning you use extreme shortcuts, but shortcuts which are logical and sensible ones. Clear? Right. Any questions on this? The other thing is, at the exam, you need to give complete answers, right? Because you can say $12 and then finish it off, but best is to say $12 per share. That's a perfect answer. That's what Ramarka has given, $12 per share, right? Whereas the others just put 12, which is not incorrect, but may not be complete. Now, it's these little things that adds a lot of value and weight at the exam. Might be the difference between a pass and a fail, because you have everything in your head. It's just a matter of putting it down on paper. Right? It's a tough battle, mind you. You need to convince the examiner that you deserve a pass. Right? You've been studying for 6 months, maybe even 1 year. Now, in this case, in the current scenario, maybe for more than 1 year, you've been studying since 2019 September, October, up to now. 1 year of continuous studies. I know all of you know. Normally, banking students are like this. This never stop studying. They always study from the time they get out of bed until they hit bed again. Even during lunch breaks at office, you all keep studying, right? So it's a lot of studies of more than 1 year, which and you only get 3 hours to convince the examiner that you have done your studies properly, that you know the subject matter, you deserve a pass. So give complete, comprehensive answers. Right now, in this case, you know it very well. You know that it's $12 per share, but you might not write per share. You might just leave it as 12. Yeah, and there is a slim possibility that the examiner will just give half of what you should get as opposed to writing per share. This will give complete answers, comprehensive answers, very comprehensive answers. You don't leave any room for error. Right? Don't leave any room for the examiner to mark you or give you full marks. Don't take that risk. Clear? Right. So, any questions on this? No questions. Right. So let's move on. Then the types of mutual funds. Right. There are two main types of mutual funds. By structure, there are two types of mutual funds, which are open-ended mutual funds and closed-ended mutual funds. Now, in terms of importance, in this lesson, you will have to know how to calculate net asset value, the types of mutual funds, and the features of hedge funds. Right? Maybe a couple of types of hedge funds as well. Right. So by structure, there are two types of mutual funds: open-ended mutual funds and closed-end mutual funds. The mutual fund can generate profits from two different sources: dividends and capital gains. Right, so mutual fund, remember you're investing in shares or units of a mutual fund, so they might give you capital gains, right? So if you had bought a unit at 10 rupees and the price subsequently goes to 15, you will have a 50% capital gain. You can also get dividends, right? Mutual funds can declare dividends. Open-ended mutual funds is a company that aggregates money from many investors and invests money in stocks, bonds, short-term money market instruments, or other securities. Right? So they get money from investors and invest in traditional types of investments. Investors purchase mutual fund shares directly from the fund itself at a price that is determined by the fund manager's per share net asset value, plus any shareholders' fees that the fund imposes at purchase. So let's say X, Y, Z mutual fund is trading at a price of 100 price. Right? then there might be fees, front-end fees of 0.5%, which is 40 cents. And so selling price of this mutual fund will be 80.4. Now, if you want to buy this from the market or from the mutual fund, you'll have to buy it at a price of 80.4. Right. If I may modify this slightly, remember the previous example we did? I'll use the same example. The net asset value. In other words, the price. If it's 12, you will have buy at the price of 12.06 with transaction cost. Mutual funds are redeemable. That means they have a maturity period. Right? Remember last week we did redeemable preference shares. Likewise, mutual funds are also redeemable. If the holder of the mutual fund shares want to sell those shares, he or she will sell them back to the fund. Right? Remember, this is a feature of open-ended mutual funds. Any questions up to now? Okay, so no questions. Then open-ended mutual funds shares cannot be bought or sold in a secondary market, such as the New York Stock Exchange or the Nasdaq. You cannot buy or sell open-ended mutual fund shares in the secondary market. There is no secondary market. It's not traded on an exchange. Then you have unlimited capitalization. That means you any number of investors can enter the fund. There is no maximum number of investors that can be invested in the fund. No predetermined date of redemption. Right? In advance, you can't say that you're going to, the fund is going to close on a given date. It's actually like a share, because the share does not have an exact date of maturity. Sale and purchase of units at current net asset value. The sale and purchase of units will happen at whatever the net asset value. And there is no restriction on entry and exit. Right? Entry and exit is freely permitted. There is no restriction. And the majority of mutual funds are open-ended. Closed-end mutual funds, it is an investing company that sells a fixed number of shares at a one-time initial public offer. Right? So it cannot be created as and when one needs. It sells a fixed number of shares at one time, at a one-time initial public offer. Shares are not continuously offered for sale. Right? Shares are not continuously offered for sale means there is no unlimited capitalization, only a certain number of shares. Remember, in equity, we did a concept called authorized number of shares and issued number of shares. Now, even in the case of a closed-ended mutual funds, there will be a particular limit on the authorized number of shares. The issued number of shares. Right? Not the issued. I'm sorry. What am I saying? The authorized number of shares. You cannot issue more than that. So there is no unlimited capitalization. After the public offering, the shares typically can be bought and sold only on a formal exchange such as the New York Stock Exchange or the Nasdaq. Right? So after the IPO, the shares will only trade on the New York Stock Exchange or the Nasdaq. Once closed-end funds shares begin to trade, their prices are determined by demand and supply and not by net asset value. Okay. So remember, closed-end funds, the price depends on demand and supply, like in shares, not on net asset value. Market price may be greater or lesser than the share's net asset value. Closed-end fund is not required to buy its shares back from investors upon request. So remember, closed-end funds don't have to buy back shares from investors even if they request. They are not compelled to do so. Right, so let me give you a small assignment. Write down the differences between open-ended and closed-ended funds. As many differences as you can. Right, so write down as many differences as you possibly can between open-ended and closed-ended mutual funds. Yeah, so what are the differences? differences between open-end and closed-end mutual funds. Yes, Shamati, you're right. Closed-end mutual funds have a fixed number of shares in issue, right? What else? What else? You all can refer the slides and tell me. Only one difference? Yeah. Closed-end funds may be more volatile. Not necessarily. Even open-end funds can become volatile. What about closed-end funds? They trade on an exchange. Right? So you buy and sell through the exchange, whereas open-ended funds or trading is directly with the fund. What else? Yeah. Good. Nimesh, you have closed-end funds have limited capitalization. Open-ended funds have unlimited capitalization. What about the unit price? Closed-end funds, unit price is based on demand and supply. Whereas open-end funds, it is based on net asset value. Okay. Clear? Any questions on this? Yeah. Right. Now you need, for the exam, you all need to know the differences between open-ended and closed-ended mutual funds. Right. You need to remember this. Okay. Right. So what we just covered was called mutual funds. Then there's another type of fund called hedge funds. Now, hedge funds are open not for everyone, right? You and I can't go and invest in hedge funds. We have to be financially sophisticated and high net worth. Right? Only open for high net worth, financially sophisticated customers. No one else can invest. This hedge fund is like a big black box. You don't know what is going inside, what going on inside. You don't know what is going on inside. It's just that they, end of the year, will give you a return. They will try to make phenomenal returns, but they will also, in the process, be taking high risk. Right? So that's where they bank on high risk, high return. Hedge funds are private and unregistered investment pools that employ sophisticated hedging and arbitrage techniques. Remember, they deploy sophisticated hedging and arbitrage techniques to trade in the corporate equity market. Hedge funds have traditionally been limited to sophisticated, wealthy investors. That is what you need to remember. Hedge funds are limited to sophisticated and wealthy investors. Right, and they employ sophisticated hedging and arbitrage techniques. which is why most investors will not understand, right? So you need to have a basic understanding of what is going on in a hedge fund. Otherwise, it's difficult to fathom what is going on there. Right? So anyway, hedge funds will be open only for wealthy investors, someone who may have enough and more money to forget about if it's lost in a hedge fund. Hedge funds may or may not use leverage, and it can make bets on global basis or look at technical aspects of a security in an attempt to find a mispricing in the marketplace. It may or may not use leverage. Now, we discussed leverage some time back, right? It's the process. About 2 weeks back, we discussed leverage. That is where you borrow money and invest. Right? Borrowing money and investing is called leverage. So through leverage, you will gain for as long as your returns are more than your cost. But the moment the return goes the other way around and it goes above cost, then you will start losing money. You will start bleeding a lot of money. Right? So hedge funds will use leverage and arbitrage. Now, arbitrage technically is risk-free, a way of earning risk-free profits. But in this case, it is also part of derivatives. So that's why you are not supposed to market these to any customer other than high net worth and financially sophisticated. Hedge funds may or may not use leverage, make bets on a global basis, or look at technical aspects of a security. In an attempt to find mispricing in the marketplace. Right. Remember Nick Leeson? The case of Nick Leeson, right? Nick Leeson was also supposed to do arbitrage trading, whereas he exceeded his authority and went beyond that. Now, unless you are conversant with financial markets, you might not be able to understand how hedge funds work. Hedge funds differ significantly from mutual funds because they generally only accept financially sophisticated, high net worth individuals. Some funds are limited to no more than 100 investors. Right? So these are the important things. Sophisticated and financially high net worth. Now, why do you think they will demand for financially sophisticated and high net worth individuals? Why aren't you and I allowed to invest in hedge funds? Why do you think that? What could be the reason? Yeah. Right, Sumedha, it was uploaded into the classroom page. You should be able to get it from there. And so why are hedge funds restricted to high net worth, financially sophisticated individuals? Why are hedge funds only limited or restricted to financially sophisticated investors, high net worth? Because of their trading strategy, right? Because hedge funds use aggressive trading techniques, very aggressive. Arbitrage and leverage, very, very complicated tools. Now, you won't understand arbitrage unless you're financially sophisticated. Right? And doing leverage is high risk. It's of high risk. So to satisfy both conditions, you need to have yeah. Right. Now, can we do the differences between a mutual fund and a hedge fund? Differences between mutual fund and hedge fund. Right. So if you're financially sophisticated, that means you know financial markets, you will understand leverage, concepts like leverage, arbitrage, and all that, right? Whereas if you're high net worth, then even if the fund is using aggressive trading techniques, it might still lose money, but you will benefit. You will at least understand what is going on. Okay, and if you are high net worth, you might be able to absorb some of the losses. Now, there is an irony in financial markets because the rich and the poor, right? If you take the two extremes, now the rich don't have to take a risk to make money, whereas they can take a risk and earn money, isn't it? They have the capacity, the firepower to take a risk and earn money, whereas the poor is the other way around. They need high returns to sustain a better lifestyle, but for that, they don't have the money. They don't have a financial cushion. So it's a dilemma. Where do you strike a balance? Right, so what are the differences between a hedge fund and a mutual fund? Differences between a hedge fund and a mutual fund. What are the differences? Yeah, excellent. So hedge funds and mutual funds. High net worth and financially. Hedge funds are open for high net worth and financially sophisticated investors. It's open for all types of investors. Hedge funds will have a limited number of investors. A small number of investors. Whereas mutual funds will have a larger number of investors. Yes, Kasun, anyone can invest in a mutual fund. Yes, certainly you're right. Then hedge funds will use leverage and arbitrage extensively. Mutual funds will use less leverage and arbitrage. Is there any questions on this? Good point, Sumedhi. These are riskier as a retirement, with an extension to what we just did. So hedge funds engage in leverage and other sophisticated investment techniques to a much greater extent than mutual funds. Fee structure of hedge funds: the manager usually gets a base management fee based on the value of the assets in the fund, such as 1% of the fund's asset. Right? So a certain percentage is charged by the manager, and managers also receive an incentive fee based on their performance that typically ranges between 15 to 30%. if they perform above a certain level, they will get 15 to 30% of the fund's returns. Right. There are two types of hedges. Now, remember, these are not hedge funds, but types of hedges. Remember, hedging is a way of reducing risk. So these are types of hedging or types of ways of reducing risk. First one is called a direct hedge. The other one is a cross hedge. Direct hedge is accomplished by hedging one asset, such as common stock, with another asset that shares similar price movements and trades in a similar fashion. An example of this would be hedging a common stock position with call options. So direct hedge is where you have access to an asset of a similar nature or the same asset, right? So you can hedge the risk of shares with another set of shares. Cross hedge involves hedging an instrument with an unlike instrument. So now if you have maybe a complex structure based on treasury bonds, you might have to use various different types of assets to hedge it, right? Maybe a combination of equity and debentures in some manner. This involves buying or going long preferred stock and hedging the position with treasury futures, right? So you need to use different types of instruments. In the case of a cross hedge, right, now we come to types of hedge funds. These are the types of hedge fund classifications. Remember, the previous slide was on types of hedges. Now the hedge funds, various types of hedge fund classifications. Right. The first one is convertible arbitrage. Convertible arbitrage. What is convertible arbitrage? Do you have any idea? Yeah, convertible arbitrage. There are different types of instruments. Now let's say debentures, right? Let's assume there is a 5-year debenture. Five-year debenture. The face value is 100. It's maturing in 5 years, right? Going at a rate of 10% annual interest. Now this debenture matures in 5 years. Okay. So this kind of debenture might have a special clause which says that when it matures in 5 years, so this is 2025 December. When it matures in 5 years, when this debenture matures in 5 years, the investor has an option to convert every 2 debentures into 1 share. The investor can, if he wants, the investor can convert 2 debentures into 1 share. Let's say this is the company's A years. 2 debentures can be converted into 1 share. Now, when the debenture matures, at maturity, he gets the face value, which is currently at 100, right? So let's say at this point, the price of A is share price of A. Let's say is $50. Right? At the initial point, at this point. The share price of A is $50. Now, 5 years down the line, if the share price remains at 50, what do you think will happen? Will the investor want to convert it into equity, or will he prefer to get his money back? What do you think the investor will prefer? If the share price remains at 50. What will he do? Will the investor convert this debenture into shares, or will he want to get his money back? If you were the investor, what will you do? You understood the question? Now, today you purchase a debenture, face value of 100. That means when it matures, you get 100. Now, this debenture has a feature which allows you to convert 2 of the debentures into 1 share in 5 years when it matures. And so instead of getting the debenture money back, you can do that also. You can convert it into a share. Now, if the share price remains at 50 when it matures, if the share price when it matures is 50, will you convert, or will you want to retire the debenture? Will you want the debenture to mature, or will you want to convert it into an equity? Any guess? Right. My question is at this point, right? Your return before that is 10%. Okay, fine. Until you get to 2025, you can't convert. Now, at 2025, the bond debenture matures, right? So you can either get the debenture money back. That means, in this case, 2 debentures, each is 100, right? 2 debentures. Let's not complicate it. Let's say 1 debenture. 1 debenture. Only 1 debenture. So the price, what you get back is also 100. Yeah. So just each debenture can be converted into a share at maturity, right? Now, in this case, if the share price is 50, when the debenture matures, you get a price of 100, right? You get a price of 100 when the debenture matures. Now, if the share price is 50, And if you convert this debenture into a share, you will get an asset or a share which is worth 50 rupees. Whereas if you had allowed the debenture to mature, you would have got 100. And so as an investor, you will want to get the higher return. That means you will want to get the debenture money back because you are getting 100. You don't want to convert it to a share which is 50 rupees. But if the price is 150, if the debenture price is 150, then what happens? Then you will prefer to convert it into a share, right? Because if you get the debenture money back, you will only get 100. But if you convert to a share, you have converted into an asset or a share which is now worth 150. So straight away, you can sell it in the market and you will make a 50 rupee profit also, right? So that's called a convertible debenture. Debenture which has the option of getting converted into a share at maturity or sometime during the lifetime. Convertible debenture. Right. Now, how you form a convertible debenture is you take a normal debenture plus the conversion option gives you a convertible debenture. Right. So let's say that the debenture price is 100. And the conversion option has a price of 10. Okay, for this to be equivalent, what should the convertible debenture be trading at? At what price should the convertible debenture be trading at? Right. So if the debenture is trading at 10, at 100, conversion option is 110. The convertible debenture should have a price of 100 plus 10, 110. Right? But what if the convertible debenture has a price of 105 and not 110? Then you have an arbitrage opportunity because 100 plus 10 should be 110, but it is going up in the market at 105, right? So the convertible debenture is cheap in the market. What you can do is you can keep buying the convertible debenture, and these two sides you can keep selling, right? You can sell debentures and you can sell convertible options, right? So this is called convertible arbitrage. Now this is something that hedge funds might attempt. They will try to do convertible arbitrage. Right, the first point, convertible arbitrage. They will exploit mispricing or anomalies in the price of convertible securities, such as convertible bonds, convertible preferred stock, or warrants. Okay, so this is the first type of hedge fund, convertible arbitrage, which will exploit mispricing or anomalies in the price of convertible securities, such as convertible bonds, convertible preferred stock, or warrants. They will buy undervalued convertible bonds and short the stock. They will buy what is undervalued and sell the stock. Then distressed securities. The next type of hedge fund is distressed securities. Right? Distressed securities means they will invest in equity which are about to collapse, right? About to go under, about to go bankrupt. Because they can buy it for a song. They can buy it at a very nominal price, maybe at negative net worth, right? So they can buy it at a very low price, and if it turns around, then they will make a lot of money. Now remember Barings Bank, Nick Leeson's Barings Bank was sold for £1. It was in distress, utter distress at the time, right? And it was sold for a price of £1 because it was in so much of distress. But Inc. Bank, which bought it, was able to sell it off for $225 million, right? So imagine the profit that they made. Listed securities are fundamentally different investments than conventional debt and equity investments. Listed securities are generally illiquid. No one wants listed securities, right? It's like another guy is getting a divorce and it's in deep trouble, distress. Making it difficult or impossible to short the securities. Okay. And so, like what I was explaining, another guy is getting a divorce. He wants you to accept the family, which you might not want. Not everyone will want it, right? So, because you can't use the family, no one wants it. Nobody's baby. But there are investors, hedge funds, who will want this. The resulting securities may be undervalued and offer superior returns, right? Fantastic returns, like in the case of Barings Bank. These funds are generally long, not hedged portfolios, right? They can only go long, they can't go short. You can't go short on distressed securities, because if you go short, the understanding is that the price will come down further. So that is not why you should go short on distressed securities, right? You should go long, always long. Long means you buy. Right? You buy a distressed security expecting it to turn around. Then emerging markets. Again, they also only permit long positions, and often there are no derivatives to hedge investments, right? Now, emerging markets are markets which are underdeveloped, which may have lots of potential for investors because the returns they offer are phenomenal. So you can only go long because no one is willing to go short on emerging markets. There are no derivatives to hedge the investments, right? So no derivatives, you need to take naked positions. The next one is called equity market neutral. It combines long and short positions in undervalued and overvalued securities. Long and short positions in undervalued and overvalued securities to eliminate systematic risk while capitalizing on mispricing. Long and short positions in undervalued and overvalued securities, remember, to eliminate systematic risk while capitalizing on mispricing. Okay, so they will try to eliminate systematic risk. They are neutral on risk and capitalize on mispricing. Because when you neutralize risk, you expect the price to come to an equilibrium level. If it doesn't reach that equilibrium level, you will have arbitrage opportunities. That's called equity market neutral. Then hedged equity strategies will take long and short positions in under and overvalued securities to exploit mispricing. Okay, so if a security is undervalued, you need to go long. If a security is overvalued, you need to go short. Unlike market neutral funds, they do not seek to remove systematic risk. They don't try to remove systematic risk. They might be net long, short, or hedged based on the manager's view of markets. So they can be net long, short, or hedged based on the view of markets. So they're not going after mispricing, and they don't try to remove systematic risk. Fixed income arbitrage. It involves taking long and short positions in fixed income instruments based upon expected changes in the yield curve and or credit spreads. Right? So you go take long or short positions in fixed income instruments based on your expectation of future market movements. Now, long means you buy. Like if you bought a car, you're long a car. If you bought a pen, if you bought this pen, then you're long this pen. What is short? Short means you sell something which you don't own, which is not owned by you. Now you buy this pen because you expect the pen price to increase. You will go short because you expect the price to drop, right? Now, when you go short, you're selling. Sorry, I'll come back to an example. Let's say I had no pens now, right? So all of a sudden I buy this pen. Let's say I bought it for $100. Now I buy this pen expecting the price to go up. Right? I expect it to go to 150. If it goes up, I will make money. But if it goes down, if it goes from 100 rupees to 50 rupees, then I will lose money. Right? So that's going long. The risk is the price coming down. So what do you mean by going short? What is meant by going short? Going short means what? What do you mean by going short? Right now I bought this pen, I went long a pen. If I sell this pen, am I going short? No. And that's called squaring off. I have squared off. Didn't have an exposure earlier. Now I bought one and I sold it. Right? I made the profit or loss. But if this pen I never had and I promised to sell someone a pen, now I am short. I have sold something which I don't own. That's called short selling. I will do that if I expect prices to come down. It's a fixed income arbitrage involves taking long and short positions in fixed income instruments based upon expected changes in the yield curve or the expected credit spread. Right, so you either go long or short on the yield curve, expecting the yield curve to change or the credit spread to change. Now, for example, when Sri Lanka was downgraded to CCC, someone who had gone short on our sovereign bonds would have gained. They could have bought it back at a lower price. Global macro strategies. Global macro takes positions in major financial and non-financial markets through various means. Right? They will look at the global markets, not just one region or one country, but global markets. Through various means, like through derivatives and through currencies. The distinguishing feature here is that they tend to focus on an entire group or area of investment instead of individual securities or classes of securities. And so they focus on an entire group of area of investments rather than individual assets, securities. Merger arbitrage or deal arbitrage focuses on returns from mergers, spin-offs, takeovers, and so on. Right? So merger is where two companies get together. Right now, classic case recently was in Sri Lanka. It was DFCC and Vardhan. Spin-off is you remove two companies which are merger is like marriage. Spin-off is the opposite. It's like divorce. Right? You segregate. Takeover is you buy a company. You go and invest in a company. It's called takeover. For example, if X announces it will acquire Y, the managers might buy shares in Y and short X, right? So based on which way, what is happening in the market, prices might either go up or come down, right? So this hedge funds will have an eye on what is going on in the market. The fund of funds. It describes a hedge fund that invests in many other hedge funds. Now it's like, for example, one hedge fund going and investing in another hedge fund. The idea is to get diversification among hedge fund managers or styles. Right? So that gives you diversification. It reduces risk overall. This idea is to get diversification among hedge fund managers or styles. There is a fee paid to the manager of the fund of funds as well as to the manager of the fund managers of the funds in the funds of funds. So lots of fees involved. It's like one hedge fund going and investing in other hedge funds. Lots of fees involved, and it's very costly. Then pension funds. So pension funds, there are two types, defined benefit and defined contribution pension funds. We will get to that. The pension fund is a fund established by an employer to facilitate and organize the investment of employees' retirement funds contributed by the employer and the employee. So, for example, our EPF, right? Employer contributes a portion and the employee also contributes a portion. The pension fund is a common asset pool meant to generate stable growth over the long term. So there'll be stable growth over the long term, hopefully, and provides pensions for employees when they reach the end of their working years and commence retirement. Pension funds are commonly run by some sort of financial intermediary for the company and its employees, although some larger corporations operate their pension funds in-house. Now, some of the older companies in the country have in-house pension funds. Provide pensions for employees when they reach the end of their working years and commence retirement, right? Pension funds are commonly run by some sort of financial intermediary for the company and its employees, although some larger corporations operate their funds in-house. Pension funds control relatively large amounts of capital, huge amount of capital. Now, the largest fund in the country, in our country, is EPF, right? Well, there is also Norway has the largest fund in the world, Norges. Now that goes around investing the wealth of the nation in we'll come back to that. Pension funds control relatively large amounts of capital and represents the largest institutional investors in many nations, even including Sri Lanka. Two types of pension funds: defined contribution pension plan. Now, that's the kind of pension plan that we have in Sri Lanka. Employees contribute a certain amount and employer contributes a certain amount, right? So every month you know how much you're contributing. The employer also know how much is contributed. But when you retire, you don't know how much you're getting. Okay, that's called defined contribution. A retirement plan in which a certain amount of percentage of money is set aside each year by a company for the benefit of the employee. There are restrictions as to when and how you can withdraw these funds without penalties. And so you can't withdraw these funds without penalties before you retire. There is no way to know how much the plan will ultimately give the employee upon retiring. You don't know exactly how much you're going to get when you retire, but you know monthly how much you contribute. The amount contributed is fixed, but the benefit is not. Right. So, in the case of a defined contribution pension plan, the benefit, the risk of the fund is borne by the contributor, right, or the beneficiary, or the employee in this case. The employee takes the risk of the performance. If the fund does well, he gets a huge benefit at the end. But if the fund makes losses, he will again take a huge hit. Right? So the risk is borne by the employee. Whereas if it's defined benefit, then the risk is taken by the employer, because the benefit when the staff member retires is fixed. He knows how much he's going to get when he retires. Right? So if there's a shortfall in the benefit when at the time of retirement, it has to be pumped by the employer. An employer-sponsored retirement plan where employee benefits are sorted out based on a formula using factors such as salary history and duration of employment. Right? So it's a complicated function, whereas where the employee benefits are sorted out. Investment risk and portfolio management are entirely under the control of the company. Right? So the employer takes the risk of the performance. There are also restrictions on when and how you can withdraw these funds without penalties. Employers will need to dip into the company's earnings in the event that the returns from investments devoted to funding the employee's retirement result in a funding shortfall. So if there's a shortfall in the benefit, then the employer has to pocket it out. Right? So the employer takes the risk. Then sovereign wealth fund. Sovereign wealth fund. Now, this is something that unfortunately we might never see during our lifetime. Right? It is the wealth of a nation in the form of a fund, right? Where the nation has excess surpluses, they pool it, they collect it, and form a fund for the future benefit of the country, right? For the benefit of the unborn. Now, for example, as I was explaining earlier, Norway has the world's largest sovereign wealth fund, right? Norway. It's called Norges. They have invested in countries including Sri Lanka. A sovereign wealth fund is a state-owned pool of money that is invested in various financial assets, right? So now, in the case of a sovereign wealth fund, they have invested for the future, whereas in most countries, including Sri Lanka, we have borrowed from the future, right? Their future earnings we are consuming in terms of, because we have excess borrowings. A sovereign wealth fund is a state-owned pool of money that is invested in various financial assets. The money typically comes from a nation's budget surpluses, right? So if a nation has budgetary surpluses, it can run sovereign wealth fund. When a nation has excess money, it uses a sovereign wealth fund as a way to funnel it into investments rather than simply keeping it in the central bank or channeling it back to the economy. Because if they have excess surpluses, they can either put it into the economy and let people start consuming as if there is no tomorrow. That is inflationary, right? Rather than doing that, they can save it for the future. The primary function of sovereign wealth fund are to stabilize the country's economy through diversification and to generate wealth for future generations, right? Stabilize the country's economy through diversification and to generate wealth for future generations, right? So these are the objectives of a sovereign wealth fund, right? So that's the end of it. Do we have any questions for today? Okay, so if no questions, we can wind up for the day, and we are meeting in 2 weeks, right? So next week is Christmas, and after that we go into the new year. So I wish all of you Merry Christmas and a Happy New Year. I will see you in 2 weeks. Thank you very much.